Right. So let's go back to the question and then let's kind of gather what the examiner is talking about. We are also much interested in the dates, okay, because the asset was being used for business purposes and then it's changed to an investment property. So first we'll be using IAS 16 to treat the assets, then second we will look at the issue about IAS 40 investment property. Right, so we are told that the asset was acquired on 1st January 2007, so 1st Jan 2007 for a cost of $400,000. No, not dollars, it's Ghana cedis, forgive me. And immediately occupied it as an office premises. So that's it. On the date of acquisition, we are told that the economic useful life of the asset. So let me put it where I kind of want to keep my economic useful life 50 years. But yeah, it's a building, so we get it. Subsequent to its acquisition, the asset was measured at depreciated cost until 1st July 2012. Okay, so on 1st July until 1st July 2012, the asset was being used by the business. So on 1st July 2012, management decided to convert that building, which they are using as office premises, into an investment property, mainly for rental purposes. Okay, so we have to ask ourselves, how many years has the asset been used for business purposes, so that we can calculate the value of the assets, calculate the total depreciation of the asset, so that we can get a carrying value as at the date that the conversion was being done. Then we can determine whether there is surplus or gain upon the conversion. We are very much interested in that. So let's do the math. So from January from 1st January to 27 to 2012. So that will be 208. So we're going to have 207, 208, 209, 2010, 2011. Okay, so 207, 208, 209, 2010, 2011. Then in 2012 July, that means that in 2012 we use the asset for January, February, March, April, May, June. Okay, so it means that the useful life of the asset has been prior to the the number of years the asset was used under IAS 16. So as per IAS 16, we are going to be looking at 5 years, 6 months. That is it. So if we are going to be calculating the depreciation, total depreciation on that 5 years, 6 months, how is it going to be? For the total depreciation on that 5 years, 6 months, it's going to be the 400,000, 2 much zeros, divided by 50 years, times 5 years, 6 months. So that will be 5.6. Sorry. It should be 5.5 years. So we can do the arithmetic for that, so that we can get a total depreciation that we are going to be charging on it. But my focus is on how long it has been used. So let's see the carrying value of the assets. Now, so as at the 1st July, the carrying value of the assets is going to be 400,000. So carrying value is going to be 400,000 minus this total depreciation. So when you work out 5 years, 6 months, the total figure is going to give us 356,000. I've already done the maths here, so you can do that. 356,000. 356,000. So this is the carrying value of the assets as at 1st July when the conversion took place. So how do we now treat the thing in the financial statements? First, we have to, for the year ended July 12, that is where the examiner is taking us from. So because of that, because in 2012 the asset was used for 6 months, we have to ask ourselves, what is the 6 months depreciation? So let me do my income statement. And you know this is an extract. So let me draw in my currency symbol. And so we're going to bring expenses, right? So when we bring expenses, the first thing we will bring is our depreciation for the 6 months. So that depreciation for the 6 months is going to be 400,000, right, over 50 by 6 over 12. Okay, and that is going to give us 4,000. So that's the depreciation we are going to be charging in relation to that asset for the 2012. Then the key thing is about other income. Now the other income, I'm supposed to bring the other income before the expenses, but I can do that as well. We have to look at the issue in relation to the revaluation for the investment property. Now, we were told that on the revaluation, what happened was that the asset was valued at 373,800. But we are told that the company uses the fair value model. What it means is that after every year, they revalue the asset. So as at 31st December, the asset was now $380,000. Right, so the question we need to ask ourselves is, what has been the value? So on the other income side, we're going to bring fair value in relation to the investment property. And that is going to be the year-end value and then the value at conversion. So at conversion, we were told that it was 373,800. But at the year end, we were told that the asset is now 380,000. What it means is that this will go actually to other comprehensive income. Okay, other comprehensive income. So after our net profit, other comprehensive income. So 380,000 minus 373,800, and that gives us 6,200. So this is the fair value surplus in relation to the investment property. This is the value at the date of conversion, that is from 1st July, get it well, from 1st July to 31st December of that year. 1st July to the 1st December of that year. So when we talk about the income statement extracts, that is what we do there. Now let's look at what happens in the statement of financial position or balance sheet, good old balance sheet. Let me just say balance sheet and go away. So my currency symbol. Now look at something. As at 31st December, there will not going to be any property, plant and equipment again, because it has been converted into an investment property. So under non-current assets, we're going to have investment property. And remember, with this investment property, what happened is that the value in relation to the investment property at the year end is 380,000. So that comes under the non-current assets. Then we come to the balance sheet. In the balance sheet, we look at the equity segment. In the equity segment, we're going to bring two items here. The first item we're going to bring will be in relation to the surplus that is going to come. Now, the surplus here is in relation to the fair value of the asset, which was 356,000. The carrying value of the asset at the date of acquisition, compared to the value that was placed on the asset at the date of acquisition, 373,800. So if you check out this arithmetic, we're going to get 17,800. That is a revaluation surplus, and that will be taken to the equity segment as well in relation to that. So that will be 17,800. Then the surplus that we are gaining between the date of recognition to the year end will also come. So the fair value surplus. So this is the revaluation sort of. Then the fair value surplus 6,000 200 as we did here. So this is basically how we account for this thing in relation to that. Now usually, since we are in other comprehensive income, okay, since we are in other comprehensive income, this 17,800 could also be recognized here, 17,800, as part of other comprehensive other income for the business, so that we will take the same thing to the equity segment in the balance sheet. So basically, these are what you have to understand. If you look at this question, it's actually looking at IAS 16 and IAS 40, and this is how the examiner is going to play tricks on you in the exam hall. Be careful and note how we unfold each of them. How long has it been used by the business? Sometimes an investment property will be changed to a property, plant and equipment, and it is the same idea, it is the same principle that you need to understand in relation to that. So when we talk about IAS 16, these are the things that you have to understand. Now the final thing is about the disclosure requirements. This accounting standard requires that the company makes disclosure in the notes in relation to the various assets that were acquired during the year, the various cost elements of the assets, any contracts in relation to any asset that has been bought, whether it was that has been acquired, whether it was leased, whether it was outright payment, or whether it was rental. We have to disclose all that. Then also any methods of depreciation that is being used, the straight line method, the reducing balance method, then also any model of subsequent measurements, whether we are using the cost model or we are using the revaluation model. All these has to be disclosed in the books of accounts in relation to that. So these are what you must understand in relation to IAS 16, and I'll see you in the next video as we talk about IAS 20 government grants.